Hi there. Welcome to The Close. I'm Lindsay Biscaya. Markets are closing in half an hour from now. But first, let's get to some of the other stories we're following in the BNN Bloomberg newsroom. Shares of Tesla are under pressure today. The EV maker reported a bigger than expected drop in fourth quarter deliveries and also posted a second straight decline in annual sales. Tesla has been struggling to boost demand for its vehicles after the withdrawal of tax incentives. Investors are also noting concern about the automaker's 2026 sales targets. And shares of Sable Offshore Corporation are surging after the company received the go-ahead to restart a contested pipeline. A federal court has ruled Sable can now begin pumping oil from its 3 platforms off the coast of Santa Barbara, California. The ruling is the latest win for the oil operation, which has been battered with lawsuits and regulatory scrutiny following a massive oil spill. And we're watching shares of Denison Mines as well. Shares of that company surging today. The Canadian uranium company says it's ready to begin constructing its uranium mine in Saskatchewan once it receives final government approvals. The project is poised to begin producing uranium by mid-2028 and is set to become Canada's first major new uranium mine since Cigar Lake. Denison warns, however, that total costs for the project are now estimated to be 20% higher at more than $500 million. And shares of Ivanhoe Mines are trading higher today, too. The miner says a smelter at its complex in the Democratic Republic of Congo produced its first copper anodes. Ivanhoe says the smelter's ramp up to 500,000 tons of copper will be completed toward the end of this year. And shipping nearly 100% pure copper instead of concentrate will cut the project's logistics costs in half. Ivanhoe holds a 39% interest in the site, which is one of the world's biggest copper producers. We'll take a look at the markets this afternoon, half an hour before the closing bell. You can see the TSX is up today, helped in part, not a lot of trading, but in part by gold and silver prices, which are climbing. When we look at U.S. markets, though, we saw some weakness in the big tech sector and big tech companies today. That slowed things down, so trading relatively flat. S&P 500 trading at 0.1%, Dow Jones at 0.5%, NASDAQ composite basically unchanged at this hour. It's that time of the year where investors look to the past and speculate about the future. So joining us for more on this is Martin Cobb, Senior Vice President at Equities at Lauren Steinberg Wealth Management. It's good to have you join us. Thanks so much and Happy New Year.
Yeah, good afternoon, Lindsay, and Happy New Year to you.
So before we look ahead to 2026, even though we're in 2026, just a quick recap on what you saw in the equity markets over the last year or so.
I mean, what a year!
Yeah.
What a year for equity investors around the world, particularly so here in Canada. I remember I remember the date because it was at Rabbie Burns, 25th of January. I had some neighbours round for dinner, and they were so scared about Canada, about investing generally in equities. And who would have thought? TSX up some 30% year to date. The relative laggard of the S&P 500 still up, over 15%. Year to date. Great year for equities around the world, despite all the noise.
I know it's been pretty wild to see how things played out, especially as you say, there was so much concern, so much worry, particularly in April, when really that tariff and trade talk started to get going. Do you expect to see the same kind of thing, the same kind of broadening out in 2026, or do you think things might moderate a little bit?
Yeah, unfortunately, I don't have the crystal ball. Otherwise, I would have retired.
Yeah, it's a guess.
Some time ago. And so, I think this is a really interesting time because, my inbox gets filled with, expectations for the year. And I think as Warren Buffett said, forecasts tell you more about the forecaster than they do the future. So any forecasts I make, I would take with a big pinch of salt. But, you're looking at the market, there were tentative signs that the performance, which has been heavily concentrated over the last couple of years, was starting to broaden out somewhat. I think we've seen tariff fatigue. I think the fact is there was so much noise, almost regardless now what happens with tariffs, almost regardless. We just got used to it. We're just getting on, doing our business, investing accordingly, etc. So I think the difference between now and maybe a year ago is starting valuations, both in Canada and south of the border, at an aggregate level, are fairly expensive. And whilst short-term, performance of the stock markets pay no attention to valuations, it is more difficult to find attractively valued, high-quality businesses today.
And we're going to get to some of those in just a moment, but I just wanted to pick up on you talking about tariff fatigue. There's been so much noise around tariffs, so much back and forth. Do you think that that's one of the key lessons that investors maybe learned from as we head into 2026, or are there other lessons that you think investors picked up on?
I think that's a very good point. Is it a lesson that we've learned? I think investors learn an awful lot in the short term and then tend to forget that over time. In the long term, their memories aren't quite so good. I think it's just the fact that we saw so much noise. We still have a position today where the vast majority of our exports to south of the border are covered by, the new NAFTA, CUSMA. We are going to be seeing in July some sort of, renegotiation of that. It's being reviewed, as we know, to some extent. I wonder if the best thing that's possibly happening is just the whole talk about affordability in the US. We saw today that, some of the planned tariffs for furniture, cabinetry makers, etc., have been delayed. You're hearing lots of noises about the cost of living. Is that going to play a part, hopefully, in just calming things down to some extent? Because as I said before on the show, tariffs are a tax on the US consumer, an import tax effectively that is being applied quite broadly. Yes, it affects trading partners, here, there and everywhere. But ultimately, I think the pain is starting to be felt. We're coming into a year now of the midterms. Republicans are starting to worry. Perhaps things will just calm down a little bit.
Yeah, it's going to be interesting to see just how the American economy fares over the next year or so. Before we get to your two stock picks today, because of course I do want to get to those, I just wanted to say you have a bit of a quote here where you see pockets of pessimism that can present opportunities. What does that, I know what that means, but what pockets of pessimism are you talking about here?
Yeah, where is nobody talking about? Pessimism or apathy. John Templeton always talked about the best time to buy was the point of maximum pessimism. Really hard to do because, the noise around that particular stock, the narrative around that particular industry, might be terrible. I like to look for just, where's nobody talking about, what's not hot, and you can find there's always areas, whether it be sectors in the market or certain geographies. We've seen how well non-US stocks have done, last year relative to the US, which is the first time we've seen that for several years. There are some really high quality businesses out there that no one talks about, and that can lead to opportunities. And they don't have to be in the AI space. We can get away from that as investors. We've got thousands of stocks to choose from. Sometimes it feels we've only got 7 because that's all we talk about.
All right. With that in mind, we'll get to some of your picks for today, Martin. The first one is Adobe. Tell us what you like about Adobe as we head into 2026.
Well, I'm a numbers guy. And if you look at Adobe by the numbers, you would say this continues to be a great business. But there's a prevailing narrative out there, and that narrative is that AI is going to eat software, all software everywhere. Interestingly, there's a narrative about 9 months ago that large language models are going to eat search, Alphabet, which was on one of the cheapest valuations that we've seen. As to show that it isn't the case. And I think the case very much is the same with Adobe. It has obviously the Creative Cloud products. And I can go on now to Sora or various other models and create images and text, etc., videos even nowadays. But I'm not cancelling my Adobe Creative Cloud software subscription because I'm not part of that. Indeed, over 10,000 people sign up for their Creative Cloud subscription product every single day. They continue to deliver something like 10% revenue growth, very high free cash flow margins. Mm-hmm. But because of that narrative, they're trading on about 15 times this year's earnings. Historically, you paid over 30 times for Adobe. To me, that risk reward is really compelling.
Just lastly, in our last minute here, the next one is Tektronic. You mentioned that they had a bit of a slowdown after COVID, but now maybe a rebound?
Yes, they own Milwaukee and Ryobi power tools business, market leader, been taking market share, long-term growth, obviously great pandemic, bit of a hangover, coming back today, enjoying sort of high single-digit, close to double-digit revenue growth, even better on an earnings per share level. Great market leader, long-term growth, and again, valuation not dissimilar to Adobe's, 15 times earnings. What's not to like?
Okay, very good. Martin Cobb, Senior Vice President, Equities at Lauren Steinberg Wealth Management. Really appreciate you joining us today. Thanks so much and Happy New Year.
Thanks, Lindsay. Happy New Year again.
Up next, we'll have more insights on what's driving retail trends in 2026 and what it means for consumers and businesses alike. More on that coming up. Stay with us. Earlier today, we dove into the retail outlook for 2026, which largely follows a shift in economic realities and cultural trends that will shape what we buy and why. For more on this, we spoke with Jessica Ramirez, co-founder and managing director at the Consumer Collective.
2025 was quite a difficult year. We repeatedly said, the consumer is shaky, the sentiment is quite tough out there. And the consumer that was most hit was middle income and low income. And I think that is only going to be, we'll only see more of that into 2026. If I think about what I've already seen in terms of credit card debt, that has already gone up. The consumer did shop for the Christmas season, but again, we have to factor inflation into that. So how does that really look into once we get those numbers? And with the high income consumer, I think we've continued to see them spend, but even they are being quite cautious. So again, I'm still giving a bit of caution where retailers will really need to hone in on how they manage their business, which they did do a good job in 2025, managing low inventories and still, dealing with tariffs. But I think the consumer is still going to be very laser focused on what they're shopping for.
Okay, let's talk first a little about the higher end consumers. You say they're going to be a little more cautious. What's driving that?
I think, despite what we're seeing in the market, there is a lot of excitement, obviously, around AI, but I think that there's still this question of, is there a bubble? And I think in terms of that market, that is the high-end consumer who is investing. And I think in terms of investment we've seen a lot around jewelry, and that's been really good in luxury. That market has continued to do very well. So we see that as that's a key investment where they feel safe. If there is a trade down, even with food, we've seen some of that even through Walmart, Costco, how the high-end consumer started trading down in some versions of grocery. So I think that's still something quite interesting to look at as indicators. I mean, they are still spending regardless, and they had last year, they did hold the majority of the retail sales up, accounting for 50% anyway of what we saw. But I think that there is still a bit of caution behind them.
Okay, and now for consumers on the lower end of the K, are they really hitting that point where they're almost completely tapped out?
Yeah, so we had done a survey last year ahead of Christmas, and most consumers told us, and it was 75,000 and less who were earning, and they told us they were either out of savings or had been dipping into savings. We also heard that they've been doing much more buy now, pay later, which has increased by a lot more into some of that. Dipping in. So again, that's new debt that we've seen. And most recently, we've seen some credit card data where it seems they have increased their debt today. So that really just seems to be, are they buying mostly for essentials? Are they buying, when even it's grocery, we started seeing Hamburger Helper last year really gain. Again, thinking of how much is that food going to last me? Instead of 1 day, is it going to last me 2 to 3 days? So again, very, very targeted in the way that they're seeing their spend.
And so what should brands be thinking about as they head into 2026 with this information?
I think in terms of what is the consumer really interested in and what are they willing to purchase? Because even on the middle income and low income consumer, as we've seen the price hikes come through, if an item, say in sportswear or in wellness, is a bit more expensive, they are actually purchasing that item. They may not be purchasing a ton of it, but they are purchasing those items. So is it something that the consumer is really wanting to spend on? Does that product offer quality even at a higher price? Value today doesn't necessarily mean that they're looking for a bargain. That's something going to be cheaply made. They are looking for something that's going to be long. We've been seeing the consumer really focus around longevity. So what does that mean in terms of wellness? Is that supplements? Is that food? Is that, what else are you adorning yourself with today if you're going out running or if you're going to work? And how's that going to make you feel better about yourself? And resale has also been something we've really been looking at in the luxury sector and also just across the board. And it's also coming from a quality standpoint. I think we've been hearing a lot about questioning what does luxury look like in terms of quality and are these prices justified, where consumers are actually going back to resale and buying some of the original items at a different price.
Okay, I want to ask about some themes that we can expect for 2026, and I want to throw in there, food is fashion. And
yes,
just curious as to what that is.
Yeah, so what we've seen a lot of is there's been, again, with the high-end consumer and the consumer being so focused on wellness, and we've seen this GLP halo effect. And I think with that is, what am I putting into my body? But also at the same time, almost like a status symbol. And you see different marketplaces coming in with higher end foods, making that a very fashion-y standpoint. And, it's almost of where do you shop, of where are you seeing kind of thing. There's merch that's being added to a lot of grocery stores, and they might be small delis, they might be something else, but there is this cachet that comes with it. And that's really where we're seeing food as fashion, where it becomes a sector that the consumer is spending on. And again, just a very much bringing high status, which we've seen that with restaurants as well, where what are consumers eating? And we see that also with the younger generation. They seem to really be caring about that part. So again, it's an interesting category of spend and just getting a glow up, I would say.
That was Jessica Ramirez, co-founder and managing director at the Consumer Collective. Well, coming up, the new Free Trade and Labor Mobility in Canada Act will come into place in 2026. More on what that means right after this. Welcome back. In 2025, we saw many in our country come together, united by a common goal to stand up for Canada. That includes the premiers of each province and territory who came into focus in 2025 on the front line of the trade fight. But as CTV's Andrew Johnson shows us, old interprovincial rivalries were also renewed.
In a year that started out looking like this.
I think Canada is going to be a very serious contender to be our 51st state.
We're going to put very serious tariffs on Mexico and Canada.
Canada's premiers, the faces of each province, became a focal point of resistance against Donald Trump's trade threats.
As Canadians, we need to realize that he is not joking.
Each standing up to defend their provincial and territorial economic engines on behalf of Team Canada. An early move, all but two, opting to remove U.S. liquor from store shelves. Manitoba's Wab Kinew took a page right out of the American president's playbook.
It's a wonderful order. It's a beautiful order. This order is pulling American booze off the liquor mart shelves.
At the White House in February, the premiers met with members of the Trump administration, presenting a united front.
The worst thing we could do as a country is not show up.
For Ontario's Doug Ford, showing up meant going on the offensive, threatening to punish America by any means possible, including restricting power sales.
If the United States escalates, I will not hesitate to shut the electricity off completely.
Ford even urged Alberta to put an export tax on oil.
Their gas prices go up $90 to $1 a gallon. They will lose their minds.
That did not sit well with Premier Danielle Smith, who called the idea absurd and self-destructive.
You can ask me as much as you like. The answer is no.
Smith, who'd been criticized for visiting Trump at his Mar-a-Lago home in January, said diplomacy, not retaliation, was the best way to deal with the president. The Team Canada narrative was also interrupted in May when supporters of Alberta separation celebrated a Smith government bill that would make it easier for voters to force a referendum. Smith said she didn't support separation, but also wouldn't stand in the way.
I will respect the outcome of citizen-initiated referenda, and that's why it's my job to make sure it doesn't get to that point.
I want to welcome everyone.
By summer, 6 months into the trade war, premiers and territorial leaders were in Ontario cottage country, talking trade, tariffs, and teamwork.
Right now, our economy in all Canada suffers because of the uncertainty.
Another goal of the three-day summit was to make it easier to move goods between provinces at a time when many discovered buying Canadian could be difficult.
I can't say how many times I've heard it's easier for me to access Alabama than Alberta.
In late September, Trump again turned up the heat, announcing new tariffs. Ontario's response got under the president's skin.
When someone says, let's impose tariffs on foreign...
A $75 million ad campaign airing on major American networks starring former President Ronald Reagan.
Over the long run, such trade barriers hurt every American worker and consumer.
Trump called the ad fake and promptly ended Canadian trade talks.
They did a crooked ad. They know it was Ronald Reagan loved tariffs.
Ontario ended up pulling the campaign early, but the man who authorized it was downright Trump-like in declaring its success.
It was the most successful ad in the history of North America.
It was around this time cracks in the Premier's Team Canada collective widened out west over Alberta's pitch for a new pipeline to send bitumen to BC's northwest coast. Despite a hard no from BC's David Eby, Danielle Smith pushed to have the proposal added to Mark Carney's major projects list.
Premier Eby's comments are un-Canadian and they're unconstitutional. All it takes is the Prime Minister to say yes.
It's not the Danielle Smith show, it's the Canadian team. And we all deserve the same opportunity for the same federal funding for our projects as she does for hers. That's not un-Canadian, that is fair.
Smith got what she wanted, a memorandum of understanding signed by the PM.
I think it's going to unleash an incredible amount of investment.
As 2025 comes to a close, with Canada and the U.S. still deadlocked on a trade deal, we can expect a continued focus going forward on the premiers, advocating for their provinces and territories and trying to get along. Andrew Johnson, CTV News, Vancouver.
Meanwhile, the new Free Trade and Labour Mobility in Canada Act will come into place in 2026, changing how provinces exchange goods. CTV's Jeremy Chiron has more on this part of it.
It's a promise the Prime Minister made often in 2025.
So we're building one Canadian economy.
A pledge to remove barriers to interprovincial trade announced last year that today came into effect. Bill C-5, the Free Trade and Labour Mobility in Canada Act, now means provincial requirements for goods and services and workers' licenses will be recognized federally too.
I think symbolically, it's a really good way to start off the year. Actual impact, I think it's really more the provinces than the feds that we're looking for action from.
A separate mutual recognition agreement signed by all provinces and the feds is set to be implemented by June. It will further impact interprovincial trade, but still, experts say some key goods are excluded and still face challenges.
Alcohol, right? Beer, wine, spirits is one example, right, that we hear a lot about. And so there are still ongoing conversations at the provincial level to make it easier to move those goods across borders.
While 2025 saw governments across the board push to trade more within the country, several bilateral agreements were signed between provinces. Experts say 2026 needs to be about follow-through.
There needs to be tangible action on the ground this year, and it needs to come quickly because the CUSMA threat is hanging over all of us.
On the international front, the stakes couldn't be higher. Canada's free trade agreement with the U.S. and Mexico is up for review this year, only putting more pressure on bolstering the domestic economy.
I think it's fundamental to our ability to respond to the threat from the United States, from the tariffs, which probably aren't going to go away soon, even though we have the possibility of a review of the CUSMA.
Formal talks are set to get underway in the coming weeks ahead of a July deadline, when a decision will have to be made on whether to extend the deal as is, negotiate a new one, or either country could decide to walk away.
Up next, we've got the closing bells on Bay Street and Wall Street. Stay with us. Okay, here are the closing bells at the NASDAQ. New 42 rings the closing bell today, and the New York Stock Exchange welcomes executives and guests of Next Gen Empire to the podium. You're watching The Close on BNN Bloomberg. I'm Lindsay Biscaya, and here's how we close the day on Bay Street and Wall Street. We'll start with the TSX. It was a quiet trading day on the first trading day of 2026. You can see the TSX ends the day slightly higher to start the new year. U.S. markets, a little more volatility there, but relatively flat. There was some big moves, big losses more so in the tech industry today. That dragged some of the markets down. But the S&P and the Dow Jones ending on a bit of a high note, and the NASDAQ down by 0.03% to end the day. If we take a closer look at some of the stocks, some of the big movers, particularly on the TSX, Energy Fuels was up more than 15% to end the day, the biggest mover on the TSX today. That stock has been trading higher over the last few days due to, in part, higher uranium sales. Denison Mines is another one. We're going to be talking about that in a moment, but it's up more than 14% on the TSX today after announcing it was going to begin construction on a uranium mine in Phoenix. More on that, of course, with Stephanie Hughes in moments. G Mining, a gold mining company based in Quebec. On the flip side, this was the worst performing stock on the TSX today, down almost 9%. Elsewhere, of course, another big story we're following is Tesla, down for the 7th consecutive day after reporting its fourth quarter deliveries. And that drop was bigger than expected, and that company definitely taking the hit as we head into the new year. Okay, so as promised, for more now, we are joined by Bloomberg Equities reporter Stephanie Hughes to talk about Denison Mines in more detail. So Stephanie, the gain today, tell us more about the latest news from this company.
Absolutely, Lindsay. So Denison Mines was able to gain by as much as 16% today, which marked its biggest intraday advance since August. It also easily made it one of the top performers on the TSX for most of the trading day today. In fact, it was the top performer before, as you mentioned, Energy Fuels dethroned it a bit. But as a consolation prize, its share price reached its highest level since at least November. And this happened after the uranium developer reported that it was ready to begin the construction of its flagship Phoenix uranium mine. So the company added that there was significant progress around, or significant regulatory engineering and construction planning progress made throughout 2025, and it confirmed a 2-year construction timeline. We got some analyst reaction from TD Cowen analyst Craig Hutchison, who said that the company was also able to develop $600 million in capital expenditures. That's about $100 million higher compared to 2023 if we're using 2026 dollars. He and his team also modeled an approximate 24-month construction timeline. So that's pretty consistent with what the company laid out there. So this is giving Denison Mines a pretty significant, strong start to the year after a mixed performance in 2025, where it started the year underperforming the TSX, but found its footing by September and gained quite a bit of momentum. And of course, today it's showing that it's putting that strong foot forward in 2026, continuing that momentum a bit. Should also note it's rising in tandem with other uranium names today, Lindsay.
Yeah, and let's talk a little bit more about the broader uranium space, those other uranium names, because it's not the only one that's gaining today.
That's right, Lindsay. Yeah, so it's also next-gen energy fuels, which ended up winning the day on the TSX. And the reason why uranium names are gaining is because of this more bullish rally around AI and the AI infrastructure names. So semiconductors were also a part of that advance. AI is really strongly powered, AI data centers, I should say, are really strongly powered by uranium and nuclear energy. So when nuclear energy is in high demand, that means uranium sales are on the rise. And then that has that domino effect of really advancing the companies that pull uranium out of the ground and process it. So we're seeing an across the board gain for most uranium miners. With Denison Mines, it's been just a double whammy of being able to be supported by that advance, and then also this announcement it made today, Lindsay.
Absolutely. So interesting. Okay, that's Bloomberg. Stephanie Hughes joining us live. Stephanie, good to see you. Thanks so much.
Thanks.
Well, our next guest says the outlook for 2026 is a half full glass with opportunities and risks on both sides. We'll break down what that means for your portfolio right after the break. Stay with us. If you ask a seasoned investor what is in store for markets, it depends is an answer you'll hear often. It's an honest reflection of how realities are not as simple as black or white. And our next guest says they're maintaining a glass half full outlook in 2026. For more, we're going to bring in Nadeem Qasim, Chief Investment Strategist and Portfolio Manager at Marnoa Private Wealth Council. And you're in studio with us. Thanks so much for coming in.
Oh, it's a pleasure to be here. Happy New Year.
Happy New Year. Yeah, the first trading day of 2026, second day of the year. Why do you have the kind of half glass full approach heading into the year?
Well, there's several reasons that we feel that fairly constructive on the backdrop for 2026. One of the key things is the earnings story remains relatively robust. And as we saw in 2025, earnings, and both in Canada and the US, if you will, were the key drivers of equity market returns in both markets. So that is in particular S&P 500 and the S&P TSX.
We saw, a 3-year bull market so far, roughly. Some could argue that. Usually, historically, that goes on for 5 years. Is that the pattern you're seeing continue into 2026?
So bull markets on average, right, and we've had, extremes on either side, right, that tend to create that average of 5 years. We're going into, the fourth year of this bull market. That doesn't mean it's going to end. Bull markets don't die of old age, if you will. Fundamentally, as I said, beyond the earnings, we're seeing a very supportive economic backdrop, right? And so from our standpoint, fears of a recession or something more systematic is not in our base case scenario.
Okay, so I know you're feeling pretty optimistic about the year ahead, obviously.
Constructive, I would say.
Constructive, okay,
Yeah.
constructive. But I mean, there is still some volatility maybe expected this year. With that in mind, like how are you advising investors to kind of head into the year?
Yeah, and look, if we look at chart number 1 or graph number 1 that I recently sent out as part of my note to clients, we've seen a fairly diversified and constructive backdrop globally. So while the S&P 500 has put up a 2025 return of about 17%, Canada, the TSX, quietly has put up a 30% rate of return. And the story is even more constructive when you look outside of the US, right? And so we're seeing very strong underpinnings, not just in Canada and the US, both from an economic growth perspective, from a monetary support or policy stance point of view, as well as fiscal spending. So again, when we look outside of equity markets in North America, we're seeing some consistencies in terms of the underpinnings of equity markets globally.
That's what's so interesting. It sounds as though, like, if we're looking at maybe potential winners for this year, it's international markets or markets overseas and maybe not so much the U.S.
Well, look, the U.S. market is deep. And so that depth allows for investors to actually find, unique opportunities. So what you are seeing, at least for the U.S. market going out to 2026, is a broadening out. That's our thesis. So we think that a continuation of, the broadening out of performance from the Mag 7 or Mag 10, if you will continue. So there are opportunities in the U.S. It's just outside of the Mag 7 and Mag 10, in more other industries that are, outside of like the infotech or the semis, if you will.
Okay, so by deep market, you mean there's other things and other sectors and stocks you can invest in the U.S., like a lot of opportunity.
Exactly, and that's within the S&P 500. So you could stay large cap oriented and still pick up some very high quality growth ideas that are outside of, let's say, that narrow aspect of the market, which has driven a lot of the growth that we saw in 2024 and a lot of that growth to the better part of 2025.
And that growth we saw in 2025, like despite geopolitical factors around the world that we're seeing, right? I mean, heading into 2026, is there anything you're watching for geopolitically that you think could maybe shake things up? Not to dampen your optimistic mindsets.
Yeah, so look, there are a lot of risks. There were a lot of risks in 2025, as we saw, right? Half glass empty, if you would, during April, right? And that quickly flipped to half full as we moved into the back half of the year, right? And so when we look at 2026, there are definitely some levels of risk that we're really focused on. The midterm elections, November, USMCA, we have to hit some level of a deadline or some sort of agreement in July. So that's going to be
a big one.
An ongoing challenge for Canadian investors, if you will. We're still seeing sticky inflation. So inflation kind of sitting at the upper end of Bank of Canada's target range, as well as for the Fed. So we probably won't get much more easing on the monetary point of view. But what we are going to see is the benefits of those cuts from 2025 work their way into the real economy in 2026, right? So there are risks for sure if inflation heats up even further, if the tariff rhetoric amps up. These are all things that continue to kind of weigh on our outlook, and that will force us to change if it materializes in a meaningful way. But as it sits today, just the earnings trajectory, valuations, again, don't seem too stretched, and I'm talking specifically for the TSX and the S&P 500. Close to 5-year averages, slightly at a slight premium, but nothing extreme like we saw during the dot-com crisis, right? So again, I think still fairly constructive. There are risks, so investors should be well diversified, not only within markets and across sectors, but also globally and across asset classes.
Speaking globally then, are there any sectors that kind of excite you that you're watching for across the globe this year?
Yeah, look, I think infotech, I think the AI trade there's still a lot more There's still more running room for that trade to materialize. We saw the first order effects probably in 2025, to some degree in 2024. Now we'll start seeing the second order effects. We'll start seeing productivity benefits. We'll start seeing other industries realize the benefits of implementing AI across their operations, right? So a lot more downstream benefits. So, if we look at Infotech in Canada and the US, double-digit earnings growth. Again, a different story, different mix in terms of the drivers of what that is, but namely in the US, it is an AI theme that is continuing to support that favorable outlook. So outside of that, I think pro-cyclical, we still like financials. Industrials haven't performed as well as some would probably hope, but again, the favorable backdrop, especially with the accelerated bonus depreciation, companies will probably opt for that in the U.S. with the one big beautiful bill, right? And so that was a key tenet of that bill that's going to enable companies to accelerate their depreciation in year one and realize the present value of essentially those benefits over several years in that same year, right? And so that allows them to free up capital and really put it to work, right? So again, I think there are reasons to be bullish on more cyclical aspects of the broader U.S. market as well as Canada.
Okay, we'll have to wait and see what exactly happens. Thanks so much for coming in.
It's my pleasure.
Appreciate you making the time.
Thank you so much.
That is Nadeem Kassem, Chief Investment Strategist and Portfolio Manager at Marnoa Private Wealth Counsel, joining us in studio. Up next, analysts say private equity saw a resurgence in 2025. Our next guest says boring is bullish. We've got more on what that means next. While public markets are fixated on day-to-day swings, private equities have been making quieter moves. Our next guest says boring is bullish. Joining us for more on this is Eric Hirsch, co-CEO of Hamilton Lane. Great to have you with us. Thanks so much for taking the time.
Lindsay, thrilled to be here. Happy New Year.
Happy New Year. So why is boring bullish? Let's start with that.
Well, I think today the public markets are essentially riding the wave of literally 7 companies. So if you're all in on the public markets right now, if you are all in on a passive approach to equity investing, you should just understand as an investor that you have essentially staked your entire savings to 7 companies who are all focused on one theme, an important theme, a very major theme, but one theme nonetheless. I think the private markets are simply showing you that there is benefit to diversification, getting exposure across geographies and across a much greater array of industries that are frankly fueling a big part of our economies.
Very interesting. So you're seeing kind of more daily volatility in private markets? Is that what you're saying, or more in public markets at the moment?
Much more in the public markets. I think you just don't see the private markets as volatile. I think if you step back and just look at kind of industry exposure, it's really the private markets that are financing, banking, and acquiring the businesses that fuel our economy. Local retail, manufacturing, power suppliers. So a lot of that is much more geared towards privately held businesses. And today in the US, for example, one of the biggest public markets, obviously, about 4,500 public companies. That's it. But if you look at where the returns have coming from, particularly in the S&P 500, they've been coming from, as you know, a very, very small number of companies. That's not a great dynamic, we think, for investors. And so if you're looking to create a much broader, diversified portfolio, we think that having a mix of public equities and private equities is the way to go.
For investors that maybe have never invested in private equities, do you have some tips in terms of how to get started and make that shift and mix in some private with public, as you're saying?
Well, I think the great part is that world has really opened up now to retail investors in a way that it just hadn't been historically. So for the last several decades, this was primarily an institutional investor game. Today, there's been a new array of products that are generally referred to as evergreen funds that are much more accessible to the everyday public investor, the retail investor. And so Hamilton Lane and a lot of our competitors have a variety of these products now that are available on a number of platforms with relatively low minimums. We, for example, have one of our infrastructure funds available at a $500 minimum. So that democratization of what we're doing in terms of getting into an asset class that was really originally geared to only very large investors has altered dramatically. And we think that's positive.
You say investors need to manage their expectations on exits. For those who are maybe new to the private world, or can you kind of explain what that means?
Sure. In the public world, you're seeing returns coming on a hour by hour, minute by minute, day by day basis. In the private world, if you think about it, just the concept of what that business is, you're acquiring a company today and you're looking to improve it, to grow it, to fundamentally make it better, to ultimately sell it in the future. If you look on average, that has historically taken 4 to 5 years to achieve what we would deem sort of high rates of return, but it's a 4 to 5 year process. So the private markets are not where you'd want to keep your liquid capital. That's much more what the public markets are geared towards, where you have constant daily, minute by minute liquidity at your fingertips. The private markets are offering vehicles that are more illiquid or semi-liquid, where you're going to be thinking about this as a much longer duration investment and needing to have the patience and the discipline to do that. But in the long run, you get rewarded for that. And if you look at the institutional investor, today on average, they're putting anywhere from 20 to 25% of their assets into the private markets. Most individual investors today have about 0% in the private markets. So I would say look to the sovereign wealth funds, look to the pension funds, look to the banks, look to the insurance companies, and look at how they're building portfolios, and then ask yourself whether that might be a good model for you as someone who is individually saving for retirement.
Interesting. Yeah. And as you say, it sounds like patience is a virtue, really, when it comes to private investing. When it comes to helping clients to manage their expectations, what else are you telling them?
Well, I think we're telling them a little bit of the where do you get diversification. We've been told so long now that the really best way to attack the public markets is going with an all-indexed, very, very low-cost approach. And while that has some huge benefits, today we've never seen concentration in a small number of companies anywhere near that we have today. So you basically have the top 10 companies in the S&P 500 accounting for almost 40% of the index's total market cap. You have to go back to the late 60s, early 70s to see anything close to that. The difference is if you go back to those earlier years, when you saw that concentration in a small number of companies, the companies were not correlated to each other. So there was an IBM and there was an Exxon. Today, that concentration is at all-time highs. And as I mentioned earlier, hugely correlated to each other, in some cases with a lot of inner dealings back and forth with those companies. So I think what we're doing is also educating people on the private markets, is getting you exposure to a much smaller company base. So market caps typically single billions of dollars, not $1 trillion, and getting you exposed across a much, much wider array of industries. And we think that's important for building out an appropriately diversified portfolio.
Just as a last question here, we saw in the public market Canada's resilience throughout this year compared to the U.S. markets. Does that same resilience go across to private markets as well? Are we seeing kind of a similar thing?
It does. I think so goes the economy, so goes both publics and privates. I think the Canadian public market much more diversified across industry and sector. And so that's just been benefiting from some relative strength of the Canadian economy.
Okay, very interesting stuff. Eric Hirsch, co-CEO of Hamilton Lane, appreciate you joining us. Thanks so much.
Pleasure being here. Thank you.
Coming up, Wedbush's Dan Ives says 2026 is an inflection point for the AI revolution. We'll hear more about that when we come back. Stay with us. Shares of furniture retailers Wayfair and RH got a boost today after U.S. President Donald Trump pushed back a tariff increase on some imported goods. The move delays a 30% tariff on upholstered furniture and a 50% levy on kitchen cabinets and vanities. The higher tariffs were due to take effect on Thursday, but they're now set to take effect January of next year. Trump says the move is due to ongoing trade talks. A 25% tariff imposed in September will remain. And the price of oil fluctuated on the first trading day of 2026. There are expectations that a supply surplus will offset geopolitical risks to production in several OPEC plus nations. OPEC is leaning toward caution, with key members expected to reaffirm a decision to pause supply increases during the first quarter. The International Energy Agency has forecast a glut of about 3.8 million barrels a day for this year. And shares of Tesla were under pressure today. The EV maker reported a bigger than expected drop in fourth quarter deliveries and also posted a second straight decline in annual sales. Sales fell nearly 9% compared to the year before, while deliveries fell 16%, missing Wall Street estimates. Investors are also noting concern about the automaker's 2026 sales targets. And the price of aluminum climbed above $3,000 US a ton for the first time in more than 3 years. That jump is due to a cap on Chinese smelting capacity, as well as constraints to European production due to higher electricity prices. Both have chipped away at global inventories. The demand outlook from the construction and renewable sectors are also contributing factors. Well, as we enter into the new year, Wedbush's Dan Ives says 2026 is an inflection point year for the AI revolution. For more on why our Bloomberg colleagues sat down with Dan earlier today.
It's really about, to me, it's about the second, third, fourth derivatives playing out across AI. Look, it's monetization. And you talk about Tesla, it's the next phase in terms of autonomous, robotics, consumer AI, especially when it comes to Apple, and I think what we're going to see. Look, I think it's a prove-it year, but that actually makes me more bullish because I think now we go into the next phase of AI. I think tech stocks are up 20-25% in 2026, but it's not just big tech, it's about second, third, fourth derivatives playing out.
I will be fascinated to see. I don't think anything is officially expected, but you're going to CES, right, which is not only the biggest tech conference in the world, but has become the most important car maker conference as well. It'll be fascinating to see if Tesla comes out with any other products there, or if we see a lot more robotics and automation products.
Yeah, and to your point, look, it all starts with the godfather of AI, Jensen. He'll be there with the black leather jacket, because when his speech, to me, is just so important on Monday, because it really starts off strategically what AI is going to look like. He's going to talk about physical AI in terms of autonomous robotics. I think the two best physical AI plays in the world today, it's NVIDIA and it's Tesla. And I think that speaks to, you talk about Tesla, what everyone's focused on. This is autonomous chapter now coming to Tesla. I think you see Musk right now, wartime CEO. That's the focus when it comes to AI, but also it's the monetization. Remember, only 3% of U.S. companies have gone down the AI path so far.
Are these robots expected to be like B2B robots, so building things in factories, or like a Roomba for consumers? What kind of products do you expect them to monetize?
Yeah, especially at CES, look, humanoid robotics is going to be front and center, autonomous. You're seeing flying cars. A lot of the presence, you talk about a lot of the tensions between U.S. and China. The presence of Chinese companies is going to be, it's going to be a monster in terms of what we see there. I think doubling, over the last few years. But I think it's really going to be about humanoid robotics. It's going to be about autonomous, but this is also going to be about more embedded AI devices that consumers are going to see. CES, we're not just talking about flying drones and refrigerators that talk to you. Now these are much more sort of front and center in terms of it's a who's who. Every big tech player is going to be there, even if they're not unofficially there. They're there to look for acquisition.
I love the idea of opening the refrigerator and having it say, "Do you really want that?" I mean, I can just imagine the future for, move over Ozempic. So there's this question here also about what some of the moves in late 2025 mean. And I'd love your take on this, because we saw some acquisitions made by the likes of Meta and NVIDIA. And I just wonder whether there's more cost consciousness and more of a competitive advantage that they're looking to solidify at a time where suddenly companies are saying, hold on, what are we paying for this and what are we actually getting?
Look, I think you hit on a great point, because the reality is it's an arms race. That's what's going on with big tech. And right now, at the top of that mountain is big tech. And when you look at like Google's win versus DOJ, antitrust, I mean, this is sort of go time for big tech. And I think you're going to see more and more acquisitions. And we've talked about not just on enterprise, on energy, and I think really across the board. And it speaks to really what we're seeing right here is that it's not just about big tech getting bigger and bigger, doing acquisitions, spending. You're going to have $600 billion in CapEx in big tech, but it's also you're going to see other players being like, don't forget about me. Look at AMD. You're going to see like, look at Cisco, look at IBM. I mean, there's going to be a lot of other players saying like, hey, we want to get into that AI party. We don't want to look through the windows, like a lot of the bears are.
We were talking about BYD triumphed over Tesla to become the world's biggest electric vehicle manufacturer. We also have seen big tech in China outperform on an equity market perspective in 2025. Do you expect that to continue and for China to really solidify more of its neck-and-neck position with the U.S. or even supersede it?
Look, I think the reality is for the first time in 30 years, the U.S. is ahead of China when it comes to tech. And I think that's very important, obviously led by NVIDIA, Microsoft, Palantir, and others. But in China, look, we're bullish on China tech. We talk about Alibaba, you look at Tencent, you look at a lot of the other names there. I think what you're seeing is it's a narrowing, but it's something where you're seeing robotics really play front and center, autonomous, EVs, BYD, and others in China. But when you think about how to play it, you have to play U.S. tech, and then there are Chinese tech players to go after. But in terms of AI revolution, like we've said, it's third inning, one out, relative to this AI game. And I think the bears, like I said, like in hibernation mode, they can see AI in the spreadsheets. And I think 2026 is going to be a year that's going to be another bull market year for, for tech and for AI.
I had really the same question as Lisa, again, because we've seen so many stories this morning about Baidu's chip unit filing for an IPO, another chip designer, I think Briner, with a very successful IPO today, maybe another mini DeepSeek moment, right, with a cheaper artificial intelligence, all among the most read stories on the Bloomberg terminal. So clients are paying attention to what's going on in China with AI. How do you bet on that? I mean, do you buy the individual stocks? Is there an ETF that you like? Do you have some of these stocks in your ETF?
Yeah, sure. So obviously, for the IVES ETF, I mean, what we really focus on is the AI 30. It was like, who are the 30 winners? We have a few of the Chinese players in there. I think Baidu, you look at Huawei in terms of the success they're having. Look, right now, NVIDIA's 4 to 5 years ahead of any other chip player. And I think that's well known. That's why even a third-rate H200 restricted, China big tech's going to line up despite what the politics in Beijing. But this is an arms race. It's the narrowing of the gap. You want to play some of those Chinese tech players, but the reality is in the U.S., from NVIDIA, AMD, we talk about our top five, Palantir, CrowdStrike, and cybersecurity. Tesla, I think it's going to be the most important year ever for them. Microsoft, I think on hyperscale right now, Microsoft, Oracle, those are names, I think, table pounders, in my opinion, in terms of what we see. And then Apple, finally, they come to the AI party instead of being on the treadmill at 2.0 speed. And now they actually start to get in terms of the consumer AI revolution, $75 to $100 per share.
There's only one company that you didn't mention that's on your list, and that's Microsoft. Where is Microsoft in terms of winning out versus Google? Who is its main competitor?
Look, in terms of Redmond, the enterprise, this is their backyard. When you think about companies that are moving to AI, the first phone call goes to Nadella. And I think you're seeing Google, you're seeing Amazon, what Jassie's doing, they're narrowing the gap and they're going to be successful. But when I look at Microsoft, you have 25, 30 billion incremental monetization. I don't even think it's factored into street numbers. That's right, in the stock ultimately has a 6 in front of it. And I think this is going to be, we're going to go into January, into earnings season. I think that's going to be kind of the show me story showing like, look, this is not stopping. Like we said, AI party started at 9 p.m. It's now 10:30, 10:45 p.m.
Me and Lisa are asleep.
Yeah, 100%. That's exactly what I was thinking.
But the party goes to 4 a.m. And that's where we are.
That was Wedbush's Dan Ives with our Bloomberg colleagues. Coming up, a look at what's ahead for the Canadian dollar in 2026. That conversation is happening right after the break. Welcome back. The Canadian dollar faced volatility in 2025, but is there a light at the end of the tunnel when we look to 2026? For more, let's bring in Adam Button, Chief Currency Analyst for Investing Live, and you're in studio with us. Thanks so much for coming in.
It's great to be here. Happy New Year.
Happy New Year to you as well. So to start off the first trading day of 2026, the Canadian dollar was down a bit compared to the US dollar. What do you make of that?
Yeah, I mean, it's early days here right now. We're trying not to draw any conclusions about the move so far. There was a bit of good news sort of in the pre-holiday period. We saw the U.S. sort of outline its position on the USMCA agreement, and it looks like they want to stay in it. Now, it's tough to take any of the signals from that, but that's going to be the big trading theme of 2026 is what's going to happen with the free trade agreement. And, you know, they're very positive about it. They want concessions on dairy, a number of other things, but it's nothing that's really critical to the Canadian economy. And I think a lot of this year is going to be a lot of noise around that.
Yeah.
And then maybe by the end of the year, we get to some certainty, which would be wonderful for the Canadian dollar.
Well, and that's optimistic as well, and good to hear, right? Because there was at one point where Washington, or Donald Trump at least, was saying that they wanted to do away with the free trade agreement completely, which is kind of scary news. So,
Yeah.
I mean, yeah.
This is something we're struggling with, you know, as a trader, because you get these headlines from Trump saying we're going to blow the whole thing up.
Right.
And then you have Jameson Greer, who is the trade representative, telling Congress in a closed door hearing, and I think they wanted to do it to close doors because they didn't want to announce that they want to stay in. And they're saying, listen, all the comments we got about this were positive. Very few people want to blow this up. Yes, there's some grievances, but maybe we can negotiate that. Then you go into negotiations with Donald Trump, and he likes to throw a hand grenade into it over and over. So you're off balance. But I think the market has largely figured out that, you know, there's what he says and there's what he's going to do. Again, we went through this with steel and aluminum a few months ago where it looked like a deal was right at the finish line, and now we're back to the start. So it's tough. Not just as a trader or an investor in the Canadian dollar, but for people who are planning businesses, who want to invest. And I think there's this, you know, this dam that's being built up right now of investment dollars that wants to go to work in Canada, but just needs some certainty. And I think it's going to take a little while yet.
And that's what so many analysts say, right? Is that uncertainty is almost worse than a bad deal because you just don't know what's going to happen. Like, if we're talking about this free trade agreement, and how important is it that we get a good deal for Canada? Like, how much does Canada's dollar hinge
You know,
on that?
and you're looking at some of the U.S. grievances right now. So you talk about dairy. Well, what is dairy as a part of Canada's economy? It's unfortunately, it's everything if you're a dairy farmer, but if you're not, it's very small. Even steel and aluminum, you know, they're pretty peripheral. Eventually, though, these things do add up. You know, sentiment is weighing. But the big surprise, I would say, of 2025 is despite terrible sentiment, a poor housing market, the Canadian consumer kept spending. You know, the numbers month after month were strong. And it just shows that people, I don't think, tapped too hard into the housing wealth when on the way up. And on the way down, it doesn't seem to have bothered consumers that, you know, their home equities might be down 10, 15, 20% in parts of the country. So I think we expect that to continue at this point. There's a bit of a mortgage renewal wave, and I think housing is going to stay a little bit in the dumps. But if we can get through this year, I think you can draw a bottom under that. And, you know, if you see bank stocks, they really rallied in the second half of the year, and they started to price this in, that it's not going to be American housing collapse redux in Canada. So there's a lot of good news under the surface in Canada. We had a 5% gain in the Canadian dollar last year. I think we can do the same this year.
Is there anything else that is really going to factor into how the Canadian dollar does this year? Like you mentioned, the housing situation Canada's in, the free trade agreement, Bank of Canada decisions maybe. Like, is there anything else that really could change what the Canadian dollar does?
Yeah, just in the next few weeks, we're watching that U.S. Supreme Court decision on tariffs. So that could come at any time, right? And if they take away Trump's tariff threat, it's a whole new ball game. Now, these things, they have a window until June to announce it. But they only give 1 to 3 days notice. This is probably going to be a January or February announcement. That really sets the table for the rest of the year. And then if you circle back to Canada, well, it's the commodity picture. You know, we have a new government in. It's a lot more commodity positive. It was a really good year for commodities in general. I think a lot of people would love to invest in gold mines in Canada right now. We're going to clarify the investment picture. Oil's probably going to bottom at some point this year after a terrible year. But again, if you look at oil stocks, they did very well in the second half of the year, despite a terrible year for oil. I think that says that people are getting a little more optimistic on these long-lived assets in Canada that are really high quality. And it's a stable jurisdiction. You're going to have a liberal government or a conservative government for the next 10 years.
At least.
And I think if you look at the investment landscape, even the United States, a lot could happen there. Britain, a lot could happen. A lot of jurisdictions, there's huge political uncertainty, and I think it's not really here in Canada right now, and that will eventually be reflected.
Is it given commodities, because you were talking about commodities, like that run we saw with silver and gold, that usually, correct me if I'm wrong, means that people are a little less sure about their currency. Is that kind of, do you agree with that, or what do you think we might see in 2026?
Well, I think that, I've been pretty optimistic, but if you look at the U.S. political situation, it's untenable. We can't keep going like this, and that's a big reason that gold rallied so well. The U.S. dollar is at the center of the global system. It was the worst performing major currency last year. It really kicked off in August when they fired the head of the Bureau of Labor Statistics. And now we have the Supreme Court decision. And I think that's pivotal for gold. If we say no more tariffs, then we have someone finally saying no to Trump. And then we can say, okay, you can hold US dollars again, the checks and balances are there. Maybe the Fed decision as well, the Fed leader. We get someone there who will push back. But if it's just the Supreme Court rubber stamping tariffs, somebody's going to cut rates to zero, you're going to have a lot of problems. And gold will go maybe even double from where it is now.
So interesting. Good to have you in. Thanks so much for coming in studio.
Thanks
Appreciate
a
your
lot.
time. That was Adam Button, Chief Currency Analyst for Investing Live. Well, at age 95, legendary investor Warren Buffett has officially stepped down as CEO of Berkshire Hathaway. More on his legacy coming up next. Wednesday was Warren Buffett's last day as Berkshire Hathaway's CEO. Bloomberg dug into how the Oracle of Omaha changed investing forever.
If investors had a Hall of Fame, Warren Buffett would occupy his own wing.
People from all over the planet look up to him, read his biography, hop on a plane to go see him talk.
He took a failing textile mill and turned it into a trillion-dollar conglomerate. It has insurance companies, Dairy Queen, railroads, and energy businesses.
For decades, Buffett's investment savvy has led Berkshire Hathaway to beat benchmarks.
One of the biggest asset managers today, which is Vanguard. The entire philosophy is no one's really going to be able to beat the market, so you might as well not even try. Well, okay, no one besides Warren Buffett.
If you look at the total returns, Berkshire blows the S&P 500 away.
The legendary investor Warren Buffett.
So when the 95-year-old announced he would retire at the end of 2025,
Greg should become the chief executive officer of the company.
it marked the end of an era at Berkshire Hathaway and left everyone with one massive question. Warren Buffett is one of the richest people on Earth, but his lifestyle doesn't exactly scream it.
He lives in Omaha. He lives in the same house he's lived for many, many years.
I'll have a sausage muffin with...
He goes to McDonald's in Omaha. A lot of people around the city know him.
He's paid just $100K and has been paid that amount for years. That's very refreshing when you think about the landscape today.
So what's the backstory? Well, Buffett's childhood fascination with money led him to Columbia Business School, where he studied under a renowned educator.
Benjamin Graham was a financial analyst considered to be the father of value investing.
Value investing is really this idea that you're not just betting on some fluke in the market. You're really looking at what you think it's worth versus what the value that the market is providing. Ideally, you want to buy a company that you think is undervalued and that it's going to rise in many years. But that requires a lot of due diligence. That requires you to make sure you actually understand how the business works.
I'm not buying them because I think they're going to go up next year. I'm buying them because I think they'll be worth quite a bit more money 10 years or 20 years from now.
Investment after investment, that strategy came to define Berkshire Hathaway. But let's see it in action by focusing on just one.
American Express is an investment that he's had for decades, and when he bought it, the stock price was a bit down because of a scandal at the time, but he saw the value of Americans that kept swiping the Amex all over the place.
That was back in the 1960s. But look at this. Berkshire's current Amex holding was largely assembled here in the 1990s for about $1.3 billion. Since then, Buffett's largely left that core stake intact. But Amex's market value has soared in the years since, making his 22% holding worth tens of billions of dollars.
He was interested because the company has a good moat. By moat, he means some competitive advantage against other companies in the business.
For Amex, that moat is a mix of its premium brand, affluent cardholders, and a network built around their spending power.
Another kind of edge you can have over your competitors is regulation.
Think about the energy business. A lot of those have advantages that a competitor couldn't come in and easily take the market share. That's really helped his business sustain itself. He's built up companies that are not so easy to replicate.
But perhaps the most underappreciated force behind Berkshire's rise is its insurance business.
They're not always the companies that are going to draw the hype from stockholders, but it's actually been a force that's built up Berkshire a lot.
The insurance business provides us with float, and float is money that we hold that doesn't belong to us.
The way it works is it has a very large insurance arm that has a lot of money from policyholders. They have to invest it to reap some benefits and make sure that they can pay claims afterwards. Berkshire Hathaway has been ramping that up to the max, buying a lot of insurance companies and using that money, the float, to invest afterwards.
This is actually one of the hottest plays in the investment world right now, with a lot of private equity and alternative asset managers either buying or having relationships with insurers.
While Buffett has been the face of Berkshire Hathaway, he long had a sidekick. Both conveniently available as lovingly hand-rendered plushies.
Charlie Munger passed away in 2023, but the dynamic he had with Buffett for many years was one of the main draws of Berkshire. They were a unique pair. If you saw them sitting together at the Berkshire annual meeting, they would banter.
I predict Charlie's going to talk about Costco. Go ahead, Charlie.
Well, Costco, of course, is a...
Munger was fundamental to Buffett's investing thesis. At the start of his career, Buffett was very into this idea of cigar butt investing, in which you would take a company, you'd take one last puff, and you'd get what you could out of it before it sort of faltered. And Charlie was one who really reshaped his thinking into thinking about companies that had a longer-term advantage.
He went from buying companies that were, not very famous, like Berkshire Hathaway, a textile mill that was struggling, to taking stakes into Coca-Cola or Bank of America.
Not that this approach is always a sure thing.
One is IBM, when he bought a stake in the early 2010. He said afterwards that it was a big mistake. He didn't see how IBM was about to lose the turn of the industry towards cloud computing.
He also orchestrated the merger of Kraft and Heinz about 10 years ago.
It just hasn't gone to plan. Part of that is down to changing consumer tastes, consumers wanting healthier things. Part of that is down to inflation. And Buffett commented recently that while he didn't think the merger in hindsight was a great idea, he doesn't think that undoing it is going to fix the company's problems.
And lately, Buffett has struggled finding companies he wants to invest in, leaving Berkshire with a record amount of cash.
It is so much easier to make very successful bets when you're managing $100 million, $200 million. He's now got a cash pile that's more than $300 billion.
And finding a place to put that capital to work is getting really difficult. He doesn't like to have money that is sitting around and not earning more money.
Higher interest rates these past few years have turned that cash pile into a nice income generator.
But it is going to get harder and harder to deploy that level of capital the bigger it gets.
So this is the Berkshire Hathaway Greg Abel is inheriting as the company's new CEO. Although sadly, we don't have a plushie of him.
He led Berkshire's energy business for so many years. But it is tricky. Warren Buffett has not only been a very good investor, but he's also pretty charismatic. That's part of the reason that so many investors have always made that trek to Omaha despite the cost, despite the distance.
Abel will also be taking charge at a time when Buffett's hallmark strategy is being tested.
It is tough to be a value investor when what's really lifting the stock market is high-growth companies. The tech company's valuation might be really high compared to sort of what the underlying assets are. While Buffett has bet on technology in recent years, his misses on those opportunities will always sort of linger.
The change in leadership also risks reviving a long-standing debate.
A conglomerate is not a thing that has stuck around. We've seen many conglomerates, such as GE, fall apart in recent years and sort of be split up.
Buffett's presence at Berkshire won't be disappearing overnight.
He'll remain as chairman, and I think his influence will still be felt by the company. He's a major shareholder of the firm, and while he's slowly divesting that stake and giving it to his children's foundations, I think his legacy will long be felt.
But Abel will be taking over many of his duties, including the writing of Berkshire's annual letter to shareholders.
This is a big change because Buffett fans have been poring over that letter over the years because it's full of witticisms, investment advice, pearls of wisdom. There's also the fact that he's not going to be taking Q&A at the annual meeting next May in Omaha.
Morning. Welcome to Berkshire Hathaway.
He was talking for 4 to 5 hours every year and taking questions from people that follow him all over the planet. That is going to be a big change because Buffett's personality is unmatched in the investment world.
Okay, that does it for today's program. Thanks for watching.